after hours, down more than 8%. But let's talk about Meta now. Q2 numbers out just moments ago. Shares there are moving higher after beating on the top and bottom lines. And joining us now is Evercore Head of Internet Research, Mark Mahaney, and CFRA Senior Equity Analyst, Angelo Zino. Guys, good afternoon. Mark, here on Meta, were you surprised at all that they didn't raise the top end of their capex guidance and that they spent less capex-wise in the quarter that they just reported than some had expected?
Well, I think there actually is a modest negative here in that they tightened up their capex range. So that's implicitly or explicitly raising their capex guidance for the year. That said, you can do that if you put revenue upside. And the revenue growth that they did, 22% year over year, was a couple of points faster than people had thought they would do, especially after kind of the Google, YouTube softness and a little bit of softness we heard from an advertising softness from names like Spotify and from Pinterest. And what this shows is that Meta's got all of its product cycles clicking at this time, and the outlook for next quarter, instead of mid-teens revenue growth, is kind of high teens on much tougher comps. And so just for those who want to know that this revenue model is sustainable and highly profitable, those margins are super high intrinsically, people come away from this thinking, Meta's in a very good place in terms of being able to generate premium ad revenue growth for the foreseeable future.
Okay, and Angelo, as we look at what Reels has been doing for Meta thus far, the AI story for them with Llama and how they're applying it internally, seeming to gain some traction. Are there still lingering concerns about TikTok and the Facebook part of the platform being dead, or no?
Yeah, I mean, listen, I think you always got to worry about the competitive pressures that are out there. But as far as kind of, Meta is concerned, I think they've kind of really navigated some of the concerns and the storms that we were hearing, 2 or 3 years ago, and executing extremely well, clearly integrating AI across their ecosystem extremely nicely. And you're kind of seeing kind of some of the fruits of their investments really kind of, play out nicely here. I mean, you kind of look at, the growth rates here for Meta relative to its peers out there. They're kind of really nicely outpacing those of its peers. And you kind of look at the guide here for Q3. We were probably more concerned about Meta relative to the others because of those difficult comps. Got the most difficult comps kind of across the space. But you kind of look at how they're performing here in the guidance. I think you've got to be pretty happy with where they're at right now.
Okay. So Mark, when you have the CFO, Susan Lee, saying here in this release that while we do not intend to provide any quantitative guidance for 2025 until the fourth quarter call, we do expect infrastructure costs will be a significant driver of expense growth next year as we recognize depreciation and operating costs associated with our expanded infrastructure footprint. I realize they didn't raise the upper end of their 2024 capex guidance. They did raise the lower. I know you just talked about that, but does that suggest perhaps that we haven't seen peak spending for this AI infrastructure build out?
I find that commentary by the CFO to be pretty vague. You could do a lot of things with that. I'll just give you my opinion, which is no, I don't think they're at peak capex related to AI. I think their capex is going to rise. Now, I think the street has that in its models. We have it in ours. You should assume that capex is going to continue to rise. The question is, are you getting a return on that? And investors need to know two things. One is that you've already seen a return with Meta over the last 2 years. I mean, they rebuilt their ad tech stack thanks to Apple's privacy changes. They rebuilt their ad tech stack using AI, and they changed their user interface and generated a lot more engagement because of AI, and it's showing up in the revenue and the profits now. Last quick point on Meta is, hey, it's not priced for perfection. This thing's trading at 19 times, 20 times earnings for something that we think can sustain 20 to 30% earnings growth. I think there's room for the multiple to rise from here. If you're a bull on Meta, you should be happy with these results.
Got it. Okay. Angelo, read through, especially on the digital advertising front. What's the read through to some of the other companies we haven't heard from? Because so far it's been pretty mixed quarter. I just look at Pinterest yesterday to see an example.
Yeah, no, absolutely. I mean, you kind of look across, maybe kind of, Meta, Pinterest, and YouTube. And, clearly we're seeing growth rates starting to decelerate here. But, some are definitely holding up better than others. I think at this point in time, it's more of a relative expectations kind of thing, right? And Meta has been able to kind of sustain their growth rates kind of maybe better than some of their competitors out there. But that said, I mean, the digital ad market still looks pretty healthy to us. Clearly coming off some of those peak growth rates that we saw earlier this year. but remains extremely healthy, and we continue to expect a fairly healthy growth pace, high single-digit growth at least in 2025.